Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like to have them on every few months because they produce a lot of thought-provoking research and articles. Doomberg, thank you for joining me again.
Jason, great to be back. Always a pleasure. Looking forward to another fantastic discussion.
So Doomberg, we talked first, I think about 10 months ago. It was pretty shortly after your first couple articles came out on a diesel crisis in February and March, diesel, fertilizer. And here we are 10 months later. It seems that the global diesel shortage, the global diesel crisis has gotten worse. Would you agree with that? Or do you think that things are actually improving?
I would say that it depends on which part of the world you're looking at. I would say in certain really important regions, the diesel crisis is reaching, code red, a critical phase, and in particular, in the U.S. Northeast of all places, really, the beating heart of the U.S. economy, for reasons we can get into. The diesel market is basically almost broken in some. Not broken, I guess, but it's gone historically off kilter a little bit with front month contracts way exceeding 1 month out, and what this really speaks to is a confluence of events, which we've written about various times and spoken about with you in this podcast long before it was front page news. But there's a chronic lack of refining in the United States relative to demand. The United States has not built a new refinery of global scale in 40 years, since the 1970s, and that's a problem. It's especially a problem when you consider the multiples of GDP growth that we've experienced over that time period. And then more specific to the Northeast, the United States is divided up into these PADDs, PADDs, and these PADDs are an artifact of the rationing of gasoline in the Second World War, and the Northeast is PADD 1. And specific to PADD 1, there are two problems. One is local refining has been shut down, as the sort of big city blue states of the Northeast have indulged in a bit of naive NIMBYism, assuming that they can always just procure the diesel they need at a consistent global market price. But that's not true, of course. And then that's in particular not true in the Northeast for a very specific reason, which is because of this artifact of U.S. law, which is 100 years old, called the Jones Act. It is actually illegal for non-U.S. flagged, non-U.S. staffed, non-U.S. owned ships to enter one U.S. port, pick up product of any kind, and then go to another U.S. port to deliver it. And since the U.S. effectively doesn't have any product tankers, the Jones Act prohibits the meeting of demand in the Northeast from supply available in the Gulf Coast. And it's crazy little market nuances like that tend to pile up during a time of energy shortage. And the U.S. Northeast in particular is hurtling towards a crisis. Inventories are at unbelievably and seasonally really scary lows. And prices, as I mentioned earlier, for immediate delivery have skyrocketed. And of course, just to top it all off, in the Northeast, in much of the Northeast, heating oil is used to heat homes in the winter, and just coming into the winter. And it's a dirty little secret, of course, that heating oil is nothing more than dyed diesel to separate the two products. They're marketed as different products, but in reality, they're the same molecule suite. And so just as heating oil demand is starting to take off, and if perhaps some people were hesitant to fill their tanks over the summer because of elevated prices, waiting for prices to come down, you really have a perfect storm in the Northeast with respect to the diesel crisis.
Were a lot of these U.S. oil refiners that were maxing out on diesel, were they also exporting it to the European Union and the United Kingdom elsewhere for higher diesel prices then?
There's some of that because of the Jones Act. So if you're a refiner in the Gulf Coast, and once your finished product goes on a boat, it's kind of out of your control, right? The boat then just sort of floats around and acts as sort of arbiters and taking the highest bid. And so it's not really the fault of the refiners per se. It's the fault of the Jones Act, which is this weird artifact of U.S. law that was meant to ensure that the U.S. Always had a merchant navy. It doesn't work. We don't have one, and yet the law still exists. And so Yeah, it's the same thing with LNG. So the Northeast liquefied natural gas. The Northeast, because of its stupid refusal to build pipelines that connect into natural gas bounty of the Appalachian Basin. Are subject to international LNG prices because once a carrier um, loads up at an LNG export facility on the Gulf Coast, once they get on the sea, they can sell to whoever they want. So at Boston, um, they will be paying very similar prices to what is on offer for natural gas in Europe and Asia, perhaps a little discount for having to travel less distance. But because of their own really naiveness about how energy really works, the Northeast is both in the midst of a historic diesel crisis, which could be catastrophic for the economy, let's be very clear, and then also subject to artificially high natural gas prices relative to what they could be getting by merely building a pipeline to connect it to the vast U.S. Natural gas pipeline network. Many large headline projects have been sued into oblivion by environmental movements, and ultimately the developers of those projects have pulled the money for those funds. And so the Northeast now is on its own, and we have to pray for a mild winter.
There used to be a lot of oil refiners. I've driven up to New York a lot in my childhood, teenage years with family to visit family up there. There used to be a ton of oil refiners in New Jersey and Delaware. So there should be the ability to get plenty of diesel from there. And then also, like you mentioned, there's a ton of natural gas that has been produced since 2008 in the Appalachians. They're building some pipelines, but I guess not to the Northeast. So this doesn't seem like a free market or capitalism problem. This seems like a policy problem. You mentioned NIMBY. For listeners out there, that's not in my backyard. A lot of people that are pro-environmental, pro-ESG, they don't want pipelines. They don't want nuclear power plants. They don't want these things around them. Well, when you want cheap electricity, when you want cheap diesel, when you want these things, the electricity just doesn't magically appear out of the outlet when you plug in an appliance or your electric vehicle.
Yeah, exactly. We wrote an article about environmental NIMBYism in Maine. There's this really fantastic lithium deposit discovered in Maine, and Maine has some of the harshest anti-mining laws in the country. It's effectively impossible to get a new mine permitted in Maine. And as it would happen, of course, this new fantastic, large, economically viable lithium mine is about 10 miles as the crow flies from a very nice ski resort. So the odds of this particular deposit getting developed is indistinguishable from zero. But I bet you, Jason, if the two of us took a road trip to that ski resort in December, we'd find more than a couple electric vehicles in the parking lot.
Yeah, unfortunately, a lot of champagne socialist hypocrites out there, they don't really understand from discussions with some of them, they don't really understand where the electricity comes from. And a lot of them, unfortunately, are anti-nuclear power. And that seems to be some of the best sources of cheap electricity.
Yeah, although I would say, at least in North America and in some parts of the rest of the world, like Japan, Poland, we are beginning to see a turning of, a return to common sense and a reemergence of nuclear as a practical, carbon-free, high-energy dense, safe form of baseload electricity. In the long run, there's very little about our economy that couldn't be powered by nuclear, and one hopes that at least one potential side effect of a deep energy crisis would be a reconnection with physics, where the new slate of leaders who would replace the ones that got us into this ditch would have a little bit more common sense. But we do see green shoots of logic, was the name of a piece we wrote a couple of months ago, highlighting the consistent positive return towards nuclear that we're seeing in much of the free world.
I think Japan and Germany are at least talking about restarting nuclear power plants, but would you say it's fair to characterize the European Union as anti-nuclear? It seems that a lot of these politicians that have come out the last 2 years have been pretty anti-nuclear power.
I think it's a little more nuanced than that. Why don't I do a little global tour? California, with a very progressive liberal governor, Gavin Newsom, recently gave a significant life extension to Diablo Canyon, which was the last remaining nuclear power plant in the state. But that one plant supplies 10% of their overall electricity and 20% of their baseload. Palisades nuclear power plant, which was shut down in Michigan, Governor Whitmer, who's in the midst of a political fight of her life, and she's up for re-election here against Dixon, a candidate against her. She is making some noise about seeing the need to restart that power plant. The Pickering nuclear power plant in Canada, thanks in no small part to the great work of our good friend Dr. Chris Kiefer at Canadians for Nuclear Energy. That plant has been saved and been given a new life. Germany has extended the last 3 remaining nuclear power plants, much to the chagrin of their economic minister from the Green Party over there. Japan is, in fact, looking to restart 9 nuclear reactors. Poland just chose Westinghouse to build its first nuclear reactor. The staunchest opponents that remain, there's some parts of Europe, but even in the UK, so the new prime minister has at least verbally committed to a nuclear future as a key element of their carbon-free energy plan. That's sort of the strangest holdout that's difficult for us to explain is the Australians. Actually, they've been blessed with a wealth of uranium deposits, and they're the biggest coal exporters in the world, huge LNG gas exporters, and yet they are violently, that is on the domestic front, against nuclear power, which is kind of bizarre. So there are still some holdouts, but if we were talking about the state of nuclear power a year ago, and I would have been able to read down that set of accomplishments for the pro-nuclear side, you'd have to categorize 2022 as a pretty darn good year.
And I think France is even talking about restarting some nuclear power plants, and they used to be the largest nuclear power plant operator. Yeah. They had Areva, but I think Areva had a lot of financial problems, and a lot of their nuclear power plants were inefficiently run, from speaking with some people who live in France.
Yeah, so France has always been very pro-nuclear. The issue with France is confidence. And so while the rest of the world can run their nuclear power plants with capacity factors, i.e. percent of online performance, in the mid-90s, pretty easily, France struggles. And France had it's been a bit of a scandal of how poorly they've maintained and how poorly they run their nuclear reactors. Maybe there's a bit of complacency. At their apex, I believe France got something like 80% of its electricity from nuclear power. France is still very pro-nuclear. They're just not very competent about running their nuclear power plants. And as I've tried to explain to many Twitter trolls, I wouldn't confuse France's incompetence with an assessment of the utility of the underlying technology in the right hands.
That's a fair point. But unfortunately, it's also in many of these countries, Doomberg, a nightmare just to get one nuclear power plant approved. I mean, in the United States, the amount of fees, regulatory agencies, construction, permitting, it takes over a decade. So for the US, just to build 1 or 2 nuclear power plants, new ones, it's going to take a very long time and a lot of capital.
Yeah, it's funny you should say that because we have a piece coming out tomorrow, which I guess will be around the time of the releasing this podcast, called Pipe Dreams, where we talk about just how impossible it is to get natural gas pipelines built in the U.S. now, and how Biden and Schumer and Pelosi reneged on a side deal with Senator Joe Manchin that basically tricked him into allowing for the passage of the deceptively named Inflation Reduction Act in return for a wink and a promise that he would get substantial concessions around making it easier to do just those types of big energy infrastructure projects. And as we show in the piece, it's going to be next to impossible to get any of these big projects done in any kind of a time frame that matters. And so if you're an investor, you kind of have to look at the situation and say, what we have on the board is what we get to play with. Who's going to make the most amount of money in an energy crisis where certain companies own bottlenecks, like, for example, LNG carriers or LNG exporters, natural gas producers that can easily get their product to the market, and so on. Those are going to be the big winners. People trying to build these projects are going to be big losers, and then resource owners that need such projects to get their product to market, they're going to suffer too.
Yeah, I was speaking with someone off the record who works at a electrical utility company. He was telling me around $15 million just in permitting fees in over a decade to move a nuclear power plant along the lines. And then you have to raise the capital for construction. And that assumes that the construction for a nuclear power plant is on time and on budget. So the amount of regulatory, the permitting process, the cost for just the permits is excessively high here in the United States.
Yeah, the cost of the permits is one thing, but the real cost is in the endless lawsuits that these well-funded environmental radical organizations, professional radicals, I call them, they will sue you. They will sue you even if you get the permit. They'll sue you again. Once you get it constructed, they'll sue you for an old permit that wasn't done correctly. The amount of money that needs to be spent and the uncertainty that comes with spending that money in court, and then all it takes is one judge somewhere, and Lord knows both sides have filled the benches with their own partisans. So it's not that hard to find a liberal judge who's opposed to the development of energy, thinks that the earth can be run on a perpetual motion machine, and to throw up a roadblock to insert uncertainty, increase costs, higher friction, which makes it just unattractive for people to do these projects. I mean, ultimately, capital goes where capital's respected. And that's why you're seeing really the only major incremental growth investment in the oil and gas sector coming from nationally owned oil producers in the OPEC cartel, because they don't have to put up with that nonsense. And so they will, over time, get more and more market power, and Biden can shake his fist again at why energy prices are so high.
Well, actually, the OPEC Plus production collapsed on its own in August. It was down almost 4 million barrels per day. So, I mean, they're not efficiently reinvesting into their business either. So there's supply problems with the national oil companies, especially the OPEC Plus countries that are outside of like Russia and some of the other main OPEC producers. There's a lot of production problems coming there too.
Yeah, of course, and also just strategic maintenance, and everybody knows that you make all your money on the price, and when OPEC is the controlling volume in the market, prices are always going up, and so that's why, even though we're seeing a massive economic slowdown with layoffs, headlines of layoffs everywhere you look, oil is still trading at the $90 a barrel. Brent, I think, is in that range as we're recording. That's pretty high historically. Coal is trading at extreme levels. Natural gas, for as much as it's come down, is still trading at extraordinarily healthy levels. It's pretty interesting, this sort of period of stagflation that we seem to be heading into.
And we could see more OPEC production cuts too. I mean, the production cuts that OPEC announced, they already happened on their own back in August with the production just falling off a cliff. But we could see OPEC announce further production cuts because they don't want to produce oil at a low price, especially when their drilling costs, all their costs are going up. Everyone's costs in the supply chain, the cost structure, there's a new normal, and the costs are up a lot the last 2.5 years.
Yeah, and beyond that, a couple of weeks ago, we wrote a piece called Listen, Jack, where we highlighted a rather unfortunate turn of events where the relationship between President Biden and the Crown Prince of Saudi Arabia, MBS, has really become deeply personal and very antagonistic. And we believe that personal animosity drove MBS to push OPEC to cut their production by 2 million barrels at the last meeting, their production targets, we should say. And so, once the SPR, Strategic Petroleum Reserve, releases are sort of good and done, and the market is still deeply short oil, what's going to happen to the price? It doesn't set up well in the post-election era. And in that piece, we did mention a pretty significant potential escalation, which is the potential passage of this NOPEC bill, which would make it basically viable for the U.S. to seize Saudi reserves. You could just imagine the tit-for-tat elevated exchange that would come from that escalatory exchange. It could get pretty ugly post-election, especially in a lame duck session if the Republicans win the election, because there'd be a lot of bitterness on the Biden side and on the side of the Democrats.
And you mentioned lawsuits for all these different energy projects. I mean, I've lived in the DC metro area for over 20 years. Some of the majority of the richest people in the area here all have law degrees. They either work for lobbyists or they have law degrees. They know how to work the system. That's not benefiting the consumer, free markets, capitalism. It's not resulting in lower energy prices, more supply. It's benefiting ESG, the lobbyists, people who know how to work the system, find loopholes, find unbidded contracts, funnel money from the Department of Energy to bad green energy and ESG companies. And unfortunately, I see that a lot worse of that, especially when they announce like these new energy infrastructure bills, these new infrastructure bills. I mean, a lot of that pork is going to be misspent. It's not going to be allocated towards natural gas pipelines or LNG facilities or new nuclear power plants, which would lower electricity costs for Americans. It's going to be unfortunately stolen, siphoned off, or stolen by a lot of the people here in DC with law degrees.
Yeah, no, there's no question that the level of grift in society grows. If you just look at the government expenditures as a percent of GDP, it's a chart we pulled up for a piece we ultimately didn't write. Going back to like 1900, it's a pretty staggering chart. And we're kissing 30% of the economy now is basically, ineffective government spending. A lot of that is Social Security and other benefits, but still the growth is pretty substantial. And it's pretty amazing to see. It's certainly not what the founding fathers had in mind when they when they created the Union of the States with as light a touch of a federal government as they could possibly try to design into the Constitution. But over time, the primary mission of a bureaucracy is to increase its budget. And given how difficult it is to reform government, this is a monster that just keeps growing. And eventually, there's only so many bricks from the bottom that you can put on top before the whole edifice collapses. So people have been warning about this for decades, but at what point, at what percent of the GDP, and this is just federal government expenditures, by the way, forget state and local, at what percent does this become sort of unsustainable?
Yeah, and the parasite that is government becomes larger than the host. It kills the host. It's siphoned off too much. I have a couple more questions, though, on diesel. So there's less than 25 days of inventory. Do you think that number is super serious, or do you think that the refiners, that number is overblown, kind of like how in gold and silver, people just talk about COMEX registered inventory for the last 10 or 15 years, and then that doesn't affect the paper gold and silver price? Is less than 25 days of diesel inventory, is that a really serious like red flag that we're gonna the people that need diesel and the costs are going to go up and there's going to be legitimate shortages?
Yeah, so I would say the market is telling you it's a real problem, given the shape of the curve. This massive premium for immediate delivery, and the inventory levels that you mentioned. If you just put them on a seasonal chart, it pops off the page. So then the big question becomes, well, I guess there are two big questions. First, how will the market respond? Because as we saw with Europe, when liquefied natural gas rose to $100 per million BTU, an unthinkable price, the entire world did everything they could to put every incremental LNG carrier into Europe. And the market responded and helped Europe achieve its storage goals. And perhaps, we'll see, because when we get to question number two, time will tell, that Europe maybe has shaved off some of the tail risk, some of the worst case scenario tail risk that it was assuming by allowing itself to get in that position in the first place. The second question for the Northeast is, beyond will the market respond, is how hard will the winter be? Because again, the Achilles heel of the Northeast is heating oil, which is effectively diesel, is one of the main drivers of keeping people warm in a harsh winter. And by the way, the history of why heating oil is still the fuel of choice to heat homes is not the prettiest one, and it has a lot to do with various unions, let's put it that way, on trying to protect their local monopolies. And so it is what it is. Will the market respond and bring incremental supply? And will the weather cooperate? But, if you ever get yourself to a point where you need sort of the miracle of the weather to bail you out, in some ways, that's the worst outcome because it teaches local politicians nothing. So I was on a podcast with my friend Andrea Steno, on Real Vision Daily Briefing the other day, and he's based in Europe, and we don't always agree on stuff, but he's a great guy. And we were talking about how the worst outcome would be Europe skates by, but barely. Because they still have to do this again for next winter. And if politicians take all the wrong lessons from this, imagine they get complacent and then we have a decent winter this year, and heading into next winter, they're even less prepared, and then they get a harsh winter. So whether or not a true crisis of supply materializes in the Northeast is kind of not relevant, right? I mean, I get it's totally relevant, but the crisis has already happened. The market has told you that the crisis has already happened. You are gambling the future health and well-being of your citizens, submitting that future health and well-being of your citizens to the whims of the gods with respect to weather. And that's just at its face, a priori unacceptable, in my view. It means the screw up has already happened, and now you're just gambling on how severe the consequences will be.
Well, I think the European Union has a very serious fertilizer crisis. So you've been writing about this also for around a year now. It's over 10 months. That's how I started finding your work about the diesel shortages, warning in January, February, and then also the fertilizer crisis. How much of the European Union fertilizer production capacity is offline right now? I think I saw somewhere in a research report it was around 70%. Is that number accurate, or are you seeing it differently?
It's a big number. I think it's off peak. There's some talk of potentially restarting some plants that had been shuttered when LNG was 3 times the price that it is today. But the crisis is real. Ammonia prices are still very elevated. They're off their highs for sure, but they haven't come as far off their highs as natural gas has, which speaks to the fact that it's a product that uses natural gas, but it also is subject to its own supply and demand dynamics, not just the input of natural gas, but the performance of the various factories, the cost curves of those factories, and how many of them are operational, and buyer strikes because the prices are too high. All the sort of ebbs and flows of a commodity price takers market exists in isolation around the fertilizer market, which is largely global because it's very easy to ship around the world. And so we were talking a little bit off air that the U.S. Fertilizer makers based in the U.S. are just making a killing right now because they can buy natural gas for globally very cheap prices, but they can then market their product at the global price for fertilizer. So if you could capture that spread between largely trapped natural gas in the U.S. and a freely traded global market for fertilizer, you're really sitting pretty. And companies that have factories in North America, but that can export to the world, are really the big beneficiaries because if you think about it, they're essentially exporting a form of natural gas at the highest prices possible. And so it's been very beneficial for people. Anytime you study a commodity market, you really have to understand the what we would call sort of the value chain. Natural gas goes to fertilizer, goes to the farmer, or natural gas liquids goes to ethylene, goes to polyethylene, goes to the garbage bag makers, which goes to the grocery store. Like there's a supply chain here, a value chain. And each one of those nodes and those chains have their own supply demand dynamics that you really have to understand before you can predict what's going to happen.
Yeah, or for miners, you're going to look at energy and electricity costs. So if diesel prices in other countries are way higher than diesel prices in the US, and a lot of miners operate outside of North America, and metals prices are falling, I mean, the miners' profit margins, they're also looking at higher labor costs, higher cost of capital. I mean, the miners are just running cash flow negative right now, especially the base metal miners.
Yeah, and there's all kinds of political risks as well, as we're seeing leftward tilts in some of the countries that we have exported our mining needs to, because again, this is a conscious decision, back to NIMBYism. It's very hard to get a new mine permitted anywhere in the US, and we need a lot of base metals and a lot of green metals, as they're being called now, zinc, copper, lithium, and nickel, and so on, that are needed to electrify the transportation space, among other challenges. We're not making new mines for those metals here, and places like Peru and Chile and parts of Africa are carrying the torch for our so-called transformation of our electricity grid and the sort of rewiring, literally, of our automotive sector. When you export those mining needs, and then you export inflation to go with it, and that inflation triggers social unrest, it just sort of shows that not much thought has got into the execution of this full value chain shift, and which means it's certainly destined to fail.
But it seems that fertilizer companies in the US and Canada, so Nutrien, which used to be Potash Corp in Canada, they bought American subsidiaries. So they run in the US and Canada, Mosaic, Intrepid Potash. Those are the three main ones. It seems like they're going to have some real benefits here with the natural gas spreads, like you're talking about, to make fertilizer and then export it, selling it into the European market, because the European fertilizer companies can't compete with the cheaper natural gas inputs.
Yeah, and if you look at a company like CF Industries, they have a huge plant in the US, but also they had a plant in the UK that they shut down. Even though they were making a bunch of cash on the U.S. plant, even at the company level, they're making a plant-by-plant decision around optimizing the economics. And so, if you just look at a company like CF Industries, they're just printing cash. Now, that doesn't mean that the stock is going to go up here. Who knows how the stock market is going to treat these companies? This information has been on the market for a very long time, and neither of us are giving the investment advice. But just as an outsider looking in, if you could buy U.S. natural gas for $5 or $6 per million BTU, you could make fertilizer with that gas, and then you could sell it where the incremental competitor has to pay $30 per million BTU for their natural gas. You're going to be sitting very pretty as the low-cost producer.
Yeah, but if it's a global macro bear market, I mean, everything is not doing well. So we'll see if the individual companies buck that trend. I know the fertilizer companies the last week or two, when we're recording this interview on Thursday, November 3rd, 2022, they've had a rally the last week or two, a pretty big one. We'll see if it sustains itself or not. But the actual businesses, like you said, it seems like they're actually sitting pretty. So if one commodity input goes down, sometimes these other commodity producers benefit. So if there was a crash in oil or diesel prices or electricity prices, the mining companies would get some type of benefit benefit. It really just depends on which is the majority of the input for a lot of these commodities producers.
Yeah, and I would say though for the fertilizer producers in general, that's a pretty inelastic market in the sense that it's not really subject to macroeconomic. Well, let's put it this way: food is among the last things people will cut out of their budget, and so it's going to be pretty robust in the face of economic. Now, there's going to be some shifting and some down selecting and tilt towards bulk and economy type foods. There's no question that there's disruption in the food market. But if you go all the way back to fertilizer, I bet if you looked into it, the sort of global demand for fertilizer doesn't fluctuate as much as, say, more luxury goods or more value-added goods, and not as quite as sensitive to the rate cycle to, say, like a base plastic like polyethylene.
So the average person who listens to this podcast, if they're a retail investor, they're just starting learning about investing or the global economy, they might not understand how important diesel is to the global economy. Could you just talk about all the different things that diesel is involved in? Because I think diesel is probably more important to the global economy for transportation and other industries than even gasoline.
Yeah. So basically, if you buy a finished product at a retail store, or you order a product online that ends up in your house, all of the moving of the product is powered by diesel, effectively. So you literally can't have a functioning modern supply chain in the absence of diesel. We wrote a piece last fall, it was almost a year ago, on the DEF shortage crisis that was emerging in Australia. The piece was called "How to Break an Entire Economy." This is sort of a subset of the diesel crisis, where the DEF fluid, diesel emission fluid, which is basically, ironically, urea, which is a solid form of ammonia dissolved in water. It's all very circular. It's fertilizer that keeps diesel trucks running. If you don't have diesel trucks running, your economy breaks, like quite literally. And the big cities in the Northeast have precious few days of inventory sort of integrated across their societies. They need those trucks to keep running. And so the supply chain would collapse. Mining companies require diesel. Diesel is one of the key inputs, as you mentioned. So you would have a shortage of mined materials to keep the economy running. There's all manner of unthinkable consequences. Let's just do like an extreme experiment. If the US woke up tomorrow and all the diesel was gone, somebody waved a magic wand, it wouldn't be many days before society would collapse.
It seems that the grocery stores would be empty then pretty quickly.
Well, the average grocery store has something like 3 to 4 days of turnover in inventory. But that's pretty scary. This is one of the reasons why I'm a bit of a preparedness-oriented individual. If the grocery stores and the food supply chain aren't willing to keep a sufficient amount of working capital to insulate themselves against such crises, I'm going to shift that working capital requirement to my home factory. And I have a robust amount of food that we rotate and eat and try not to waste. But that's a very good insurance policy against such circumstances. Lots of people would roll their eyes and think that we're being crazy by thinking in such ways, but best to have and not need than to need and not have.
Couple more questions before I let you go. So it seems that the European companies are getting hit the worst with higher energy input costs for electricity, diesel. Their costs are up a lot. Do you expect these governments then to subsidize or bail out, say, German manufacturers? Because we're seeing in the headlines the last 6 weeks, I think BASF, which is one of the largest chemical companies in the entire world, they announced they're leaving Germany because they don't have cheap energy inputs to make plastics and chemicals. And I think one of the largest German soap companies in the world, I think they were in business for 120 years. And a lot of people might not be aware of this, but a lot of soap is actually made with petroleum products. I think they just announced that they're going bankrupt or insolvent in the last month or so. So do you expect then these governments, the policy reactions are, we're going to save jobs, we're going to do energy subsidies or bailouts with this crisis instead of maybe trying to fix the supply problems that we've highlighted in the last 30 or so minutes about pipelines, LNG import and export facilities, or cheaper nuclear power? They'll just do subsidies and bailouts of the manufacturing companies instead of fixing the energy supply problems.
So it looks like they are going to prop up the consumer by giving them bailouts and price caps on the home energy requirements. And they're leaning on industry to save cut the demand of natural gas that they need to get through the winter. And so this is by necessity going to be hyperinflationary locally because they can't print their own energy. They can't buy energy and settle in their own currencies. They have to buy US dollars to settle for the energy needs. But also, you are artificially propping up consumer demand while suppressing domestic production. So you know what that does to price. But as a consequence of this, we are beginning to see a massive deindustrialization of Western Europe in general and Germany in particular, which the history books will be writing about for some time. You know, when you live through monumental tectonic shifts like we're seeing right now in Europe, because they take weeks and months to fully materialize, you sort of become deadened to the news. In 10 years, I can assure you that the winter of 2022, regardless of how it plays out from here, will be viewed as a historic blunder and a crisis of epic proportions. And it will have long-lasting consequences to the shape and conduct of global economic flows and global commerce. And it's just because we sort of get the drip effect every day. It's hard to take a step back. Again, when we first started writing about the natural gas crisis in Europe all the way back in October of 2021, if you would have told me that BASF, which is born and raised and its heart and soul is in Germany, that they would be permanently closing substantial portions of their German chemical production and heading to China, I wouldn't have believed you. The same thing for aluminum smelters and zinc smelters and automotive manufacturing. Like all of these energy intense industries can't compete. And it doesn't take too long of no competing before you're basically irreversibly out of business. Now, some of these companies will reorganize and the crisis will eventually pass, hopefully in a couple of years, and they will reconstitute, but the damage is significant. The scars are real. And the second and third order impacts of this are just now starting to be seen. And so it's really been sad, but almost like surreal for us to watch all of this unfold. Like the answer was always very clear. Any country that cannot produce its own primary energy in a period of primary energy shortages is screwed. And there's no amount of financialization, rebates, politics, job owning that solves the original molecule problem. And so, you know, and yet these politicians still, in aggregate, don't seem to have learned the full lessons. And that's why, as I said earlier, if Europe just skates by this summer with a deep recession, but mild winter, and they don't run out of natural gas, and they avoid rationing, you know, forced rationing. They're certainly rationing now. If they avoid forced rationing and rolling blackouts, they will have learned all the wrong lessons, and then look out for the next one. So it's, I tell you, in 10 years, you're going to be looking back at 2021, 2022, and many books will have been written about the blunders and the brainstorming and all of the consequences that happens when you have these deep scars towards the global economy.
So why do you think a company like BASF, which needs cheaper energy input, so cheaper oil, cheaper gas, cheaper oil, cheaper natural gas liquids to make plastics and chemicals, why do you think they're not considering moving to the United States? Why do you think they're moving to China instead?
Can't build anything new here. Good luck trying to get, you know, I mean, there's been some new crackers put in the US, and there was a period of time where you could get projects like that done. But good luck building a new Verbund site on the U.S. Gulf Coast as a chemical maker, especially, you know, one with perhaps some limited experience in navigating domestic regulatory systems here in the U.S. Now, BASF certainly knows how to do that. They have a big presence in the U.S., but I'm just saying in general, far easier to take your business elsewhere, where governments are a bit more pliable and a bit more realistic about the permitting process and the surety of contracts and so on and so on. And so, you know, capital goes where capital is respected. It's just that simple. And if after you read our piece tomorrow, you know, pipe dreams, you'll see some pretty vivid examples of where professional, many hundred millions of dollars worth of funding of lawyers exists merely to object to, delay, increase the cost of, and obstruct the development of our energy infrastructure. There's only so long that money is going to try to crack that nut, and they'll just move on to greener pastures. And existing holders of those assets will print a lot of cash because shortages will drive price, and they'll be sitting there sitting pretty like the refiners are in the United States today. So look, if you're a refiner in the United States, U.S. hasn't built one. If you own one and the industry is running at 95% capacity and diesel spreads are blown out to all-time highs, you are printing cash. Now, Biden is threatening confiscating those profits with windfall profits tax. That's never going to get to Congress. There's money to be made by owning inelastic sources of commodities that are desperately needed by society.
And I also don't see a lot of evidence of new oil supply coming online. I know there's been some increases in U.S. natural gas supply, LNG exports coming out of Norway and some OPEC countries, but not a lot of increases in oil production. I think the U.S. has had a little bit of an increase, but the rest of the world is not drastically increasing their oil production despite the higher oil prices the last 12 months.
Well, let's give you some numbers. So just prior to COVID, the U.S. had expanded its daily production of oil to 13 million barrels a day. Post-COVID, for a variety of reasons, oil seems to be topping out at 12 million barrels a day. And just by coincidence, the size of the 180 days worth of Strategic Petroleum Reserve releases by Biden has been roughly 1 million barrels a day. So while we have been draining the SPR and oil prices have come down from the mid 120s to the high 80s, we have been artificially conditioning the world to assume that the U.S. is basically going to be producing and or releasing roughly 13 million barrels a day of oil. If production truly is rolling over, and data like drilled but uncompleted wells would indicate that easy stuff is gone, just as it becomes unacceptable to drain the SPR even more, or worse still, that Biden ultimately decides that it's time to refill it again, you're looking at potential supply shock on the oil side of the equation, especially if OPEC doesn't play ball and the Western world continues its crazy game of obstructing the development of new sources of primary energy. So, we're in a bit of a lull in the crisis for the past 2 or 3 months, a thankful one. But I think once we get by next Tuesday, once we get through the elections, once everybody puts their cards on the table, it's going to be a fascinating few months to watch in the energy sector.
The funny thing is I've seen some oil experts come out and say that the SPR oil dumps have had no effect whatsoever on the oil price. I would beg to differ. I think the market has expected for months more SPR oil dumps. And in talking with oil traders, there's been a lot of games with paper oil futures contracts, similar to gold and silver, where there's like a 9 AM paper price smash with the oil futures in an attempt with, just blowing out stops.
Yeah, there's some rumors of that, and the Saudis kind of referred to it vaguely in an interesting comment a couple of months ago. But ultimately, unlike gold, oil is needed, it's burned, it's refined, it's used. And ultimately, when push comes to shove, the physical market will dictate the long-term price of oil. You can play around with it in the futures market, but these futures, you can stand for delivery. And as we saw in the opposite equation, when there was no place to store it at the peak of the COVID crisis, oil went negative. That same inelasticity that drove the price of oil to minus $37 a barrel could drive it well above 100, 150, 200 for a short period of time, as there's just not enough of it to meet supply obligations. And so, unlike gold, the paper market for oil is weaker relative to the physical market for oil. The price of oil delivered in Asia is what Saudi Arabia says the price of oil delivered in Asia is, not what some desk jockey traders in the U.S. are trading paper back and forth with each other. It's not what they say it is. Saudi Arabia is setting the price for oil. People will use the paper market as a benchmark if they think it's fair. If they don't think it's fair, it will be replaced. Ultimately, anytime you analyze a commodity contract, a price that you're seeing quoted on the screen, you have to ask yourself a couple of questions. Does the industry actually use this benchmark to transact? Can you stand for delivery? And how much of this is a financial product versus a real delivery product? And unlike gold, oil is a 100 million barrels a day. That's an awful lot of oil. That's what, $10 billion a day transacted in the real world. There's no way that a smashing down of a futures market at 9 a.m. is going to be able to hold down that balloon underwater for very long, in our view.
Yeah, I mean, the Saudis have also said that, and other oil ministers in OPEC have also said that they're more willing to do supply cuts over the last 3, 4, 5, 6 months. So there will be additional supply cuts if the oil price looks weak. The OPEC producers are going to say, well, our costs are rising. We're not going to increase output. We're going to lower the amount of supply, and we're going to move the price higher, because a lot of these, the average person isn't aware of this. The cost for a lot of these oil production oil drillers, their costs are up over 15% per year for a lot of these oil producers over the last 2.5 years.
And their governments have become accustomed to those revenues. So there's a lot of political pressure to that. And by the way, as we talk about OPEC, a good friend on Twitter, Dr. Nas, has taught me a very interesting thing. When you're analyzing OPEC, there's actually three legs to the stool, as he describes it. There's the production targets, there's what they actually supply, and then there's the price that they put on that supply. And when you read a headline of just production targets, you have to go one step further. How much are they actually producing, and how much are they supplying? Because they have their own inventory buffers. So they might cut production by 1 million barrels a day for a headline, but supply an incremental 1 million barrels a day out of their own reserves for a temporary period of time. And they may price it differently in different regions of the world to try to get flows to go a certain way. So, for example, Saudi Arabia, you could interpret some moves by Saudi Arabia that they increase prices in Asia to make it more palatable for people in Asia to buy Russian oil, so that they could help Vladimir Putin out by raising price in Asia for their Saudi oil. Again, because it makes taking the risk of running afoul of U.S. sanctions a little bit more valuable. So there's all kinds of nuances. You have to get below the headlines to see how the market really works. We learn those every day. But again, what they produce, what they supply, and how they price it are the three legs of the OPEC stool that you need to complete a thorough analysis of what their actions are really telling you.
Well, I think the Saudis are still the world's lowest cost producers, but I don't think they're producing for $10 to $30 a barrel anymore. I think with inflation, all the higher costs, they're drilling deep water offshore wells that is replacing guar. I think their costs are closer to between like 30, 40, 50, maybe even $60 a barrel now. So they are still the lowest cost producer, but their costs are up a lot too.
Yeah, I don't know those exact numbers. I do know that Saudi Aramco, which is of course the publicly traded but nationally controlled oil company in Saudi Arabia, they're printing an enormous amount of cash right now. So I'd have to go in and see the numbers, but they're not hurting in this environment.
Oh yeah, I agree. They're actually a fairly efficiently run national oil company, but a lot of these other national oil companies are not as efficiently run. Petrobras was paying out around 60% of their free cash flow, but now with the elections, I think it looks like the politicians now that are pro ESG and anti fossil fuels, they're going to start going after these oil and natural gas revenues for these national oil companies.
Yeah. And, again, I one of my pet peeves is when people underestimate the technical prowess of a company like Saudi Aramco. It's a company we know well from personal experience. This is one of the most technically sophisticated, engineering dense, very well run, efficient companies. And you'd stack up Saudi Aramco against any of the U.S. majors any day. And the U.S. majors and the people that work at them would tell you the same thing. We have a bit of a techno arrogance in the West where we assume like Sinopec and Saudi Aramco and,
well, doesn't the Saudis, they hire a lot of American oil workers. I mean, there's a lot of American oil workers living in Saudi Arabia. So
yeah, of course. But they hire the best from around the world, the very best engineers from India, IIT. When you have all the money, you can hire the best people, and there is a price for people to move to the desert. I know many people who worked in Saudi Arabia for extended periods of time, made life-changing money, did good work, and then came home. And so, this techno arrogance that we have in the West, that we assume that because Western companies pulled out of Russia, that somehow Saudi Aramco, China, and the big name company in India is escaping me now, but like that these companies don't have any engineers. Like I've been to IIT Mumbai. It's a brilliant school. The people that are lucky enough to get into that school are absolute geniuses. And the same thing with, Fudan University in China, and pick your favorite East China University. And Like these schools are really world class, and they're producing thousands and thousands of petroleum engineers where we're producing next to none. Like we are losing the technical fight, but we're sitting around here convincing ourselves that we are superior. It's really, I think, underestimating your geopolitical enemies is a very dangerous thing.
Yeah, I agree. And a lot of US tech companies, the social media big tech companies is in Silicon Valley, they weren't hiring Americans. Well, unless the Americans were in marketing or sales or something like that, and they were champagne socialists, millennials making six figures. I mean, the actual technical people they were importing from other countries. So the computer programmers, the engineers, the other people, they were not Americans. I've spoken with people that are in hiring departments for these large companies, and they want to hire American computer programmers. There's just not any ones, hardly any American computer programmers at these major universities. Most of them are foreigners at American universities.
Yeah, and that's it's a great thing that the U.S. still attracts these brilliant foreigners to come study in the U.S. because many of them stay here and they become very productive taxpayers when they become, first through the green card process and eventually become citizens. That's a big benefit of the U.S. The U.S. is a beacon for such people. It is still the land of opportunity. It still has many great. It's blessed with many great endowments. The federal government has not yet chipped away at all of those, despite their best efforts. But by and large, my main point is we do ourselves no favors by underestimating our geopolitical enemies and their technical expertise. Because if they don't have it, they'll steal it. And technology can be bought.
So in wrapping up this interview, you expect then, based on policy problems, not free markets, not capitalism, policy problems, continued energy supply problems, continued supply chain problems, because these politicians, these bureaucrats are not approving pipelines, LNG export facilities, nuclear power plants, oil and natural gas drilling permits. So that's the main problem the last 2.5, 3 years.
Yeah, it's a great way to wrap up. I think until we see a serious pivot in the seriousness with which our ruling class accepts the fact that, especially during times of primary energy shortages, energy is the master resource, we will be stuck in the same do loop of incompetence until a true crisis hits that shakes people, it shakes them back into common sense. One only hopes that the size of the crisis is small enough to scare our leaders, but not too large to inflict irreversible or substantial harm to our society and to our institutions. But until we start making our own energy, now the U.S. again is largely energy dependent. So when I say us, I mean I mean like Western Europe and the developed nations that are short energy today. Until we get serious about developing primary forms of energy ourselves, we're going to be beholden to nation-state actors that might not have our geopolitical interests in mind, and that's unacceptable. It's unnecessary. It's an own goal. And if anything good comes out of this crisis, maybe the realization upon the electorate that this is an issue worth voting for will be a positive one.
And we're going to see higher prices and more shrinkflation, unfortunately, at the grocery store and at restaurants. And it's not going to be covered in the consumer price index. The producer price index actually has been a lot more accurate, I would say, than the consumer price index here in the United States. The producer price index, which is stuff that you and me were talking about the last 40 something minutes about costs for these businesses, input cost, supply chain problems. The cost for the producer price index has been running almost double the consumer price index at 16% over the last 12 months.
Yeah, no, it's until, and again, unless the Fed hikes the economy into a depression, it's hard to see how that turns around. So yeah.
Yeah, I see more problems in the supply chain. In some cases, it's even getting worse because of diesel, energy. I mean, there's plastic items that there's face cream that I haven't seen because of the plastics and the other materials, and I haven't seen it available for sale in for 4, 5, 6 months. So there's still serious supply chain problems in a lot of different consumer items.
Yeah, indeed.
Well, if my listeners want to take a look at your excellent research articles on your Substack or follow you on Twitter, how do they do so?
Yeah, great. I appreciate the chance to close with a plug, Jason, and again, enjoyed the discussion. Looking forward to coming back in a couple of months. We are available for subscription at doomberg.substack.com. We are 100% subscriber supported. We accept no ads and nor sponsorships. Nothing wrong with those business models, but we like to have complete editorial freedom, and so we are 100% subscriber supported. Since we've last talked, we've been blessed to have achieved the number one position in financial Substack category globally, which is really amazing and humbling and thrilling all at the same time. You can also find us on Twitter at Doomberg T. Add the letter T for Twitter to the end of Doomberg. We just crossed, I think, like 208,000 followers on Twitter. Really great account, fun to run. We post there daily original content. It's not just an outlet for our Substack. We view our Twitter account as a sort of the free offering of our thinking and our research. But the predominant place where we do most of our work is at doomberg.substack.com. And once again, Jason, thank you for having us back on. Looking forward to doing it again soon.
Yeah, you've really been way ahead of your team. You and your team over Doomberg have been way ahead of the curve on diesel fertilizer problems, highlighting this. And on your Twitter, I mean, you're sharing articles. So you were talking about the problems in Boston, New England 12 months ago with stocking up on heating oil. So you were giving people warning that if you're living in those areas, you need to stockpile when the prices were cheap ahead of time.
Indeed, indeed.